Hey everyone! Guess what? This morning, DBS just smashed through an all-time high at $47.05. And because DBS is the largest stock in the Straits Times Index, or STI, it helped push the entire index to 5 straight intraday records this week. Now before you think you've missed the boat, you haven't. In fact, I'm about to show you why Singapore's stock market might be one of the best places for long-term dividend income right now. So stick with me till the end, because I'll walk you through the exact strategy you can use to grow your passive income using blue-chip stocks, REITs, and ETFs, especially if the market dips again. If you want more Singaporeans to discover these income strategies, give this video a like and subscribe to Wealth for You, your trusted guide to financial freedom in Singapore. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research or consult a licensed advisor. Chapter 1. What is the STI? Let's take a moment to unpack something that every Singapore investor should know. What exactly is the STI? The STI, or Straits Times Index, tracks the performance of the top 30 largest and most liquid companies listed on the SGX, our local stock market. It's like Singapore's very own blue-chip buffet. You've got the 3 big banks, DBS, OCBC, and UOB, telco heavyweight Singtel, industrial and engineering giants like ST Engineering and Keppel, and major property names like CapitaLand. These are the backbone of Singapore's economy. Strong earnings, steady cash flow, and consistent dividend payouts. That's why so many long-term, income-focused investors love them. As of 18th July 2025, the STI has climbed over 21% on a price-return basis year-to-date. Now, if you include dividends, that's the total return, it's a bit more conservative, with estimates putting it between 6% and 7.5% year-to-date, depending on the source. And while people used to say the Singapore market was boring, let me tell you, this year, it's anything but. The STI has hit 5 straight intraday records this week. Now let's talk long-term. Over the past 5 years, the STI's total return, including dividends, has been around 13.8% cumulatively, or roughly 2.5 to 2.6% annualized. Not sky-high, but hey, it's stable, it's predictable, and for income investors, that's gold. What about dividends? As of now, the SPDR STI ETF has a trailing 12-month dividend yield of about 4.2%, with forward estimates at 4.3%. Historically, STI dividend yields range between 3% to 5%, and we're sitting in a healthy middle. So yes, when you combine steady price growth with reliable income, the STI really starts to shine. So if you thought the Singapore market is dull or too slow, think again. It's defensive, it's cash generating, and with all this movement in 2025, not boring at all. Chapter 2. Why DBS is soaring to new highs and why investors are watching closely. So, why is DBS hitting new record highs on 18th July 2025 at $47.05, even though its first quarter profits dipped slightly? The answer is quite straightforward. It's rock solid. DBS remains one of Asia's strongest banks, with a well-diversified business and resilient balance sheet. It pays reliable, growing dividends, which is exactly what income investors love. In a high-inflation world, dividend consistency is king. Singapore is seen as a stable and trusted market, especially in times of global uncertainty. So guess what? Big money, especially institutional investors, is flowing in. And here's the date to mark on your calendar. 7th August, DBS will be announcing its half-year 2025 earnings. Many investors will be watching closely to see if it maintains its momentum and dividend strength. With a market cap of over 132 billion Singapore dollars, DBS isn't just a heavyweight, it's the largest constituent in the STI. So what DBS does, the entire Singapore market tends to feel. Chapter 3. STI is still undervalued, even at record highs? Okay, so you might be thinking, wow, STI hitting record highs. Too late to enter, right? Not necessarily. Here's the thing. Even though the STI has climbed impressively in 2025, it's still trading at a price-to-book ratio of just 1.36 times as of mid-July 2025. And that's way below its 2007 peak of 2.5 times, right before the global financial crisis. In simple terms, the valuation today is still very reasonable. To give you some perspective, the U.S. stock market, like the S&P 500, is trading at price-to-book ratios of over 4 times, nearly triple what Singapore's STI is at. So if you're looking for value, stability, and yield, the STI is not just affordable, it's a global bargain. And we're not just talking about any old companies. Many STI component stocks, like DBS, Singtel, ST Engineering, Capital Land Investment, and Keppel, are actively evolving. They're recycling assets, launching new growth strategies, expanding globally, and still paying strong, reliable dividends. These aren't stagnant old-school counters. They're modernizing, innovating, and returning value to shareholders. So when you invest in the STI today, you're not just buying past performance. You're getting quality businesses at fair prices, with steady dividend income and room for future growth. It's what I like to call the sweet spot for income investors. So if you're building a long-term dividend portfolio for the future, the STI is still a great place to start, even at these levels. Chapter 4. Your roadmap to building steady dividend income in Singapore. Let me walk you through a strategy that's working for more and more Singapore investors. And yes, even the big institutions are doing it. So, step 1. Start or keep going with dollar cost averaging. Imagine this. You set aside a fixed amount each month and put it into the SPDR STI ETF, or a solid REIT ETF. No stress over timing the market. Just slow, steady building. Over time, this approach has historically delivered over 6.5% CAGR, and it's honestly one of the simplest, most effective ways to build long-term passive income. Plus, ETF assets on SGX have surged 150%. And that's not just from retail investors. Institutions are piling in too. Step 2. Reassess S-REITs. They're making a comeback. You might have heard that REITs struggled when interest rates were high, and that's true. But now, things are shifting. SORA, the interest rate benchmark, has dropped from 3.7% to 2.1%. Yet REIT prices haven't fully caught up, which means there's potential upside. Meanwhile, S-REITs are still yielding about 7% on average. And the fundamentals? Solid. Retail and office rents are rising, occupancy remains high, and leverage is healthy. 40% versus a 50% cap. If you're thinking ETF, here are a few you can look at. Lion Phillip S-REIT ETF, Nikko AM Asia ex-Japan REIT ETF for some regional flavor, and APEC Green REIT ETF for those who want ESG exposure. Step 3. Mix broad exposure with high-quality dividend picks. If you're aiming to grow consistent dividend income, a good approach is to combine broad market exposure with a few strong individual stocks that are transforming and rewarding shareholders. Start with something steady, like the STI ETF, which gives you access to Singapore's largest, most stable companies. It's like owning a slice of Singapore's economic engine. Then, consider adding a few high-quality dividend stocks that are actively unlocking value and boosting their payouts. Here are 3 strong examples. Singtel. They're unlocking 9 billion Singapore dollars in assets and returning value to shareholders through potential dividend increases. ST Engineering. Tapping into AI and robotics, with a new dividend policy that could mean more cash flow for investors. DBS, a proven performer with a strong dividend track record. That said, share price is high now, so you might want to wait for a better entry point. Together, this combo gives you broad diversification, income stability, and growth potential, a great setup for long-term investors. Step 4. Avoid over-concentration in banks. For years, the common strategy was buy banks, sell REITs, but that trend is starting to reverse. Institutional money is rotating into REITs and industrials. Don't just follow what worked in the past, look ahead. And remember, banks are now trading at higher valuations, while REITs and industrials still offer attractive entry points. Step 5. Build a war chest. Be ready to buy when opportunities come. Here's one smart habit that separates the seasoned investors from the rest. They always keep some cash ready to invest, especially when prices dip. We call this a war chest. It's not about trying to time the market, it's about being prepared. So when great dividend stocks or REITs go on sale, you can scoop them up confidently. Think of it like this. Market dips. You're not panicking, you're shopping. STI or REITs pull back. That's your moment to increase your yield on cost. New opportunities pop up? You've got dry powder ready to deploy. Even allocating a small portion of your monthly income to your war chest can make a big difference over time. Remember, cash flow-rich investors don't just hold assets, they make their money work smarter with every move. Whether you're just starting or refining your strategy, this roadmap gives you a diversified, income-focused approach. 1. DCA into ETFs or blue-chip dividend stocks. 2. Reassess REITs. 3. Combine broad market exposure with quality dividend stocks. 4. Don't go all in on banks. And 5. Build a war chest and stay ready. Because building wealth isn't about chasing trends, it's about stacking reliable income month by month, and letting that cash flow grow quietly, consistently, and powerfully. Chapter 5. Cash flow over ego. Let me leave you with something important, a mindset shift that completely changed how I invest. And maybe it will for you too. Don't chase being rich on paper. That's when your portfolio looks impressive on a screen. But it doesn't actually pay you anything. No passive income, no real freedom, just numbers. Instead, focus on being cash flow rich. That means holding assets like dividend-paying stocks, REITs, and ETFs, the kind that put money in your pocket month after month. Because at the end of the day, it's the income that pays your bills, gives you flexibility, and lets you live on your own terms. Cash flow is freedom. Everything else is just noise. Final thoughts. Let's grow wealth the smart way. So there you have it. Singapore's dividend story? It's not just alive, it's thriving. Whether you're just starting or already on your journey, remember this. Stay invested, stay consistent, and always aim to be cash flow rich. Not just rich on paper. If you found this video helpful, do me a small favor that makes a big difference. Give this video a thumbs up so more Singaporeans can discover this content and start building income the smart way. And if you haven't yet, subscribe to Wealth for You and tap the notification bell so you never miss strategies to grow your passive income, one dividend at a time. I'm cheering you on. Let's build that income stream and live life on your own terms. See you in the next one.